All right. Thank you, ladies and gentlemen. Welcome once again to EWTV, where we look at our financial issues, financial circumstances. We have been dealing with the Nssf Act of 2013. We have already done episode 1 and 2. Now we are on to the third one, which I will refer to as the second last, because you're going to deal with the last and the final, the fourth and the final, around the same time. Uh, in say next month, we can give it a break until you have clear data statistics in order to be able to calculate the figures. Today I'm going to give you raw figures. I'm not going to be so qualitative, but rather very quantitative intentionally. I'll just give you a brief history why this NSF Act, although this can you can make reference to our previous episodes. Reason why NSSF came into being in the first place, and why there have been efforts to ensure that it is refined as much as possible to ensure that it can actually serve the purpose as currently is, to conform or map it to the current situation for it to be more effective. Now, this NSSF, the National Social Security Fund, and the idea came about in 1965. The idea behind it was basically to provide social security or financial security for people who are going into retirement. Now, over a while, it has morphed. It has been changing to align it to the prevailing circumstances since then to now. Um, Now, in the year 2013, there was need to refine this state fund further to ensure that it then aligns itself to the realities, the economic realities. One, remember that our old NSSF fund, the one that we just moved from to move to this one, was what we refer to as in pensions balance or in term and benefits balance as a provident fund, where upon retirement, then you get your monies or funds or benefits or whatever you want to call them in the entirety. So remember, we are contributing 200 shillings as an employee. Then the employer contributes another 200 shillings on behalf of the employee. So 400 per month is sent to the NSSF, to the state fund. Looking at the 400 shillings, obviously that wouldn't be enough to cater for our people in their retirement. So that's what necessitated the need to refine, to be able that number one, it provides adequacy. Number two, it expands the scope. Number three, it besides just the retirement benefits, then you put in some further benefits. I've spoken about those benefits in my previous episodes. So in case you get more curious about what are these other benefits besides the retirement benefits, then I would want to refer you to my previous episodes. Um, so when this act came into being in 2013, it faced a lot of legal hurdles. We have a group of Kenyans who went to court, who thought it was illegally passed. So there have been courtroom battles since then to now. But in 2023 February, this act got a limelight. So that then paved way for its implementation, meaning that we then officially were moving away from the 200 employer consecutive contributions to now a percentage based and a two-tier based contributions to the NSSF, to this new NSSF. Remember that I've said that initially we're doing 200 shillings for the employee, and employer contributes for you 200 shillings. But there are those people who are in their formal employment, so those ones who are doing what you call a voluntary contributions to the fund. Now, this one has now moved away from being a provident fund to what we refer to as a pension scheme. A pension scheme, the difference between a provident fund and a pension scheme is that upon retirement, a provident fund, you get a lump sum. The money is the employer has contributed for you, plus what you have contributed for yourself, plus the investment income thereof. So that is then calculated, put into your bank account as a lump sum. For a pension, it works a little bit more differently. Is that you can only be allowed to access in lump sum 1/3 of your accumulated credit or your accumulated lump sum. Then the 2/3 is then used to acquire for you what we call a retirement income. Now, this retirement income, I'm sure we shall come and talk about them. What are they? Because there are two. So we shall come and discuss them later. But today I just wanted to engage my audience in terms of, because now we're in February. Remember, each February every year from 2023, the first implementation was, I talked about it, February 2023. That was year one. February 2024 was year two. February 2025 was year 3. So February 2026 is year 4. And these contributions have been progressive in terms of amounts. So it's going to affect this. I'm just basically going to give you some clue on how your payslip is going to look like at the end of this month. For those ones who are already been paid, I know, because there are those employers who pay early. Already those individuals have looked at their payslips. They could be happy, they could be sad, depending on how they look at retirement savings. Now, the implementation now of this Nssf Act of 2013 paved way for, remember, now the contribution mode also changes. I was almost forgetting that we now move away from contributing as a flat figure of 200 to a percentage based. Now, this act then provided for that an employee would contribute 6% of their pensionable emoluments. Remember, I said I'm not going to go into definitions, so those ones can be found in my previous episodes. So 6% of your pensionable emoluments, you are deducted that from your salary. Then the employer also contributes the same amount to the Nssf. But remember, besides the contribution rate, because of the impact this was going to have on employees' salaries or payslips, the government decided to face it for 5 years. So it began in 2023. Now, full implementation now will be done 5 years, 2023, so 2027. That is when now we shall be now fully applying the 6% on what we call our maximum on our pensionable emoluments. So the figure will still go up next year. And remember again that besides the introduction of contributions, a percentage on your salaries, these contributions also structured in a manner that it has got 2 tiers. So we have what we call tier 1, and then we have tier 2. For the benefit of this, for today's discussion or presentation, I'll give you the advantage of defining for you what is tier 1 and then what is also tier 2. Now, you need to be very careful and very keen. Tier 1 is defined in this act as contributions by and in respect of a member up to the lower earnings limit. If you want to know what a lower earnings limit is, again, I said I'm not going to go into definitions. Kindly you go or you can go into the comment sections and then, just ask me. I'll be able to respond to you. That's tier 1. Contributions by and in respect of a member up to the lower earnings limit. Definition of tier 2. Tier 2, these are contributions by and in respect of a member above the lower earnings limit. One is up to, another one is above. So that's the difference between tier 1 and tier 2. One is below, up to the lower earnings limit, another one is above the lower earnings limit. Fine. So I'll quickly run you through the figures, because I know I'll make it as simple as possible, because I know if you look at your payslips, then you'll be able to relate what I'm talking about and actually what is happening on the ground. Now, year 1, 2023 in 2023 in February, our contributions or your contributions to Nssf was 1060. 1060, if I'm not very wrong, if I was just to confirm, was 1060. A figure like that one. It was 1060. No, 1080. Sorry, it was 1080. Why was it 1080? Because the lower earnings limit was put at 6,000. The upper earnings limit then was 18,000. So if you take 6% of 6,000, you get 360. For those of you who are quick in mathematics. Now, remember I've said the upper earnings limit was 18,000 shillings. So basically, your pensionable emoluments, if I was to use that term, for year 2023 were supposed to be a maximum of 18. So regardless of whether you earn 50,000 shillings or 100, for purposes of these Nssf calculations, contribution calculations, the maximum would apply 6% on would be 18,000 shillings. So we have already used 6,000 shillings to calculate year one. So 6,000, 6% of 6,000 is 360. Remember, we have talked about a maximum of 18. So for you to be able to get year two, then you must get 6 from that 18. So you remain with 12,000 for purposes of calculating tier 2. Now, 6% of 12,000 shillings gives you 720 shillings. That's why your total remittance to Nssf in the year 2023 was 1080, 1,000 shillings and 1,080 shillings. Year one. Year two was obviously now 2024. The lower earnings limit was put at 7,000. So it's been progressive since year one. The lower earnings limit, year one, 2023 was 6,000. Year two, it became 7,000. Year three, it became 8,000. Year four, which is now this one, it has become, or it shall be, 9,000 shillings for purpose of calculating tier one. Now, what this act says is that for the first year, the upper earnings limit will be 50% of the national average earnings. Remember, we said we are not going to go into definitions. So you can find time and look at and go find, either refer to my previous episodes, or you can go and find out what are these, national average earnings. I'll be somehow mean with, this information this time around, but because I've already given the same information. So year one, they're saying that it will be 50% of the national average earnings. Year two, it will be the national, 1 times the national average earnings. So if year one, it was 18, which is 50% of the national average earnings, then meaning that the national average earnings for year two is now 18,000 times 2. So which is 36,000 shillings. So now we are into year two. Lower earnings limit, maximum is 7,000. Upper earnings limit, maximum is 36,000. So then let's do our mathematics quickly. 6% of 7,000 shillings gives you 420. That's tier one. 420. Tier two, because you've already used 7,000 shillings to calculate tier one, then we cannot again use it to calculate tier two. So we have to remove it from the 36,000 shillings. So 7,000 shillings minus 36,000, you get 29,000 shillings. So 6% of 29,000 shillings, you get 1,740. So your total contributions, I know you can relate to this. Your total contributions in 2024 that was deducted on a monthly basis and remitted to Nssf was 2,160. Yeah, for those of you I know who can remember this, those of you who are keen with your payslips, you can carry up your hand. Those of you who can't remember, then you can actually go back and refer to your payslips. Now, year three, which was last year, actually ending, that ended in January this year, beginning February last year to January, end of January this year, because now we are officially into year two, into year four as we speak. So your lower earning limit maximum, your lower earnings limit maximum was 8,000. 8,000. Remember what the act says is that for purposes of calculating your national average earnings for year 3, it will be 2 times the national average earnings. Remember what you say, that for the year 2024, the national average earnings were 36,000. So 2 times national average earnings is 72,000. So you've been given the lower earnings limit maximum and you've been given the upper earnings limit maximum. Upper earnings limit maximum for year 3 was 72,000 shillings. Lower earnings limit for year 3 was 8,000 shillings. So 6% of 8,000 shillings, what do you get? You get 480. So that was your tier 1 contributions to the Nssf. 480, tier 1. For purposes of tier 2, your emoluments for purpose of calculating the contributions to Nssf was, now you get the 72,000 minus the 8,000 which you have already used for calculating tier 1. So you remain with 64,000 shillings. So 64,000 shillings, 6% of 64,000 shillings, it gives you 3,840. So if you get tier 1 plus tier 2 to get the total contributions on a monthly basis, a figure now that you can relate with on your payslip was 4,320. That is what, including January this year, if you have to look at your payslip, the total contribution to Nssf was 4,320. This figure varies because there are those people whose salary is obviously not 72,000. They could be having 50,000. So they will not contribute that 43. So that's why I'm using the maximum limits. But if you have to look at tier 1, then you realize that then those figures that I'm mentioning, the first year was 360, the following year was 420, the third year was 480, and now we are going into those figures will be consistent. But for the tier 2 contributions, the figures will obviously vary because we are not all earning the same amount of salary. Now you start realizing that people's tier 2 contributions now start going down. Some even start falling off completely. But I don't think there's anyone now who has. Yeah, there could be someone who fell off. For those ones who earn, let's say, less than 36,000 shillings, those ones must have fallen off. So you can't find them in what I'm discussing right now. But those ones who earn more than 36,000 shillings, you realize that probably that tier 2 contribution has gone down, but they're still making that contributions to Nssf. Now let's come to year 4. Now the elephant in the room. What is going to happen to your payslips this month? One is we have the lower earnings limit maximum, which has been put at 9,000 shillings. Then we have got the maximum, the upper earnings limit maximum, which has been put at 108,000 shillings. So what do you do to get tier 1 contributions? You come and get 6% of the 9,000. So 6% of 9,000 shillings is 540. 940. Because we already used the 9,000 to calculate the 540, so we go and get the 9,000 shillings from the 108,000. So we remain with 99,000 shillings for purposes of calculating our tier 2 contributions. So 6% of 99,000 shillings is 5,940. So we get our tier 1 contributions plus tier 2 contributions. Tier 1 contributions plus tier 2 contributions, then we come to a figure, we arrive at a figure of 6,480. So for those ones of you who have not gotten their payslips and your salary is above 100, your basic salary plus non-fluctuating emoluments is above 108,000 shillings, your payslip, you will be deducted 6,480,000. This is what will be deducted from your payslip. The employer is also expected to contribute a similar amount on your behalf. So I think up to that particular point, we are now good. Year 1, total contributions, you are doing 1080. Year 2, you came to 2160, which I think a majority of people were doing that. Year 3, it was 4320. Year 4, it is 6,480. So regardless of whether you get 120, for purpose of calculating these Nssf contributions, our maximum is 108. So whether you earn a million or 2 million, we will not be interested into 6% of your 2 million. No, our pensionable emolument, the maximum, is 108,000 shillings. So which will give us 6,480. Now, having looked at the mathematics for year 5, let's get the data first. Then we can be able to calculate for you what will be your contributions for the year 2027. But that now will be the final year, because then that will apply to the numbers, 6% of the numbers that we shall be given by the CS in charge of these matters, Treasury. Now, I felt like I needed to mention a few things. That we look at this fund, the intentions are good, but in terms of management and governance, NSSF has fell short of expectations. And in realizing that, the government itself then allowed members of pension schemes or provident funds who have got already established ones that are compliant in terms of both Retirement Benefits Authority Act, the RB Act, and the KRA, the Income Tax Act, basically allowed these schemes to be able to do what we call contracting out. I will not again go into those definitions, but contracting out, it means that you can, tier 1 contributions must be and has to be taken to NSSF regardless of what. Now tier 2 contributions is what you can play with. You can take it either to NSSF if you want to, or you can take it to, if you have got an already established occupational retirement benefit scheme that is compliant with the regulations and the act, basically then you can take these tier 2 contributions as your protected rights into an already established retirement benefit scheme. Now, this retirement benefit scheme can be an occupational pension scheme or provident fund. It can be what we call an umbrella retirement benefit scheme, or you can take it into an individual retirement benefit scheme. So those are the destinations that your tier 2 contributions can actually end up in. But tier 1 contribution has to go. Although in terms of access, the act is what then dictates how you access both tier 1 and tier 2. It will not be based on the trusted and rules of the scheme that has accommodated these tier 2 contributions. That's why they're called protected rights. Reason why you need to save for retirement, very basic. Number 1 is for your financial security. You just for your peace of mind, for your dignity in retirement. To just give yourself reliance. You don't need to depend on your kids to be sending you money. Nowadays, they don't do that. Thank you very much. I think that brings me to the end of the numbers. My name is, as usual, Emmanuel Wafula. I'm a financial consultant. I have helped quite a number of clients be able to establish this tier 2, manage their tier 2 contributions, set up for them, make their occupational pension schemes compliant for purpose of receiving these tier 2 contributions, advise them on the destinations possible, whether individual or umbrella schemes that will then give you a return on what you have invested, then enable you to live very comfortably in your retirement. So with that, I don't want to go into much. I look forward to seeing you again in our last episode 4. But for today, I just want to thank you for listening to me. If you got any questions, kindly you can do comments, and then we shall be glad to be able to come back to you. We also do financial advising, various across the road, be it insurance, be it investments, be it pensions, be it annuities, be it income drawdowns. Kindly be able to reach us. Thank you very much and good evening. Thank you.